Multi-time frame analysis is like black magic to even seasoned traders very often. Well, it's not really that difficult. You just need a couple of rules. And whether you use 10 time frames or 3 time frames or 6 time frames like me here on this layout, it doesn't really matter. It's important that you have rules for each of your time frames and that you only look for specific things on each of these time frames. For example, you could look for momentum on the weekly chart, for trend on the daily chart, and for daily bias from the candle. You could look for levels and bigger technical analysis formations on the 4-hour and the 1-hour. And then the 15 and the 5-minute is your execution time frame. That's pretty much how I do it. Important is really that you don't flip through time frames, because if you start doing that, then you are going to be all over the place. And I think multi-time frame analysis really has a huge benefit. And that is that you are trading either with the trend from the higher time frames, or you're trading away from decent levels as a counter trend trade on a higher time frame, which could already be a trend trade on a lower time frame. Because if you think about it, okay, we are bumping into a level on the weekly chart, we have a bit of a reaction here, maybe a bit of a pullback on the 1-hour chart, and then here we get in, for example, and that is then the wave 3 in Elliott wave theory, or whatever you want to call this, an ABC, a 1, 2, 3, doesn't really matter. The fact is, there was a trend change on a lower time frame, a rejection on a higher time frame, and you are trading now with the trend on a lower time frame. That's it, which is essentially a counter trend trade on a higher time frame. So if we look at a trade that I recently took on the GBP Swiss here, I took the rejection of the 50 EMA right here. Why did I do that? Multiple reasons. Firstly, we had a 2-bar reversal, 1 bar down, 1 bar up on the weekly chart, and the next week was a nice continuation candle of this 2-bar reversal. We can then draw a trend line here, for example, on a daily chart, and we see that we have broken this nicely as well. Now we are pulling back into one of my moving averages. On the daily chart, this is the 20 EMA. And on the 4-hour, this is the 50 EMA. On the 4-hour, I can also draw a trend line here, which we are faking out. I can also copy that trend line up here, which then gives me kind of a channel. You can see we had some trouble breaking out of that channel here. And whenever you see a channel in the direction of the trend, this is arguably an uptrend on the 4-hour chart, you see a channel in the direction of that trend, and then you see a fake out of that channel against the trend, then very often these are great trades. Some of the better trades of my career have come from this constellation. Then there are some other things that we can see here. For example, this used to be a supply zone on the daily chart, which has now become support. Supply and demand zones can be inverted just like support and resistance, break and retest before moving higher. So we have plenty of reason to believe that indeed this is going to be where price pulls back to and then hopefully continues the trend. So once we have that thesis in place, then we go to, for example, the 1-hour chart, where we can also see, okay, here we made a very classic price action pattern, which is a double bottom followed by a fake out. This is one bottom, this is the second bottom, this is the tiny fake out. Now we're moving higher. Now, of course, on the 1-hour time frame, we can then once again draw a trend line and wait for that to break before we get in. Or we can go even lower to the 15-minute chart, the 5-minute chart, and look here for our entry models, whatever that may be. You can look for classic patterns like the head and shoulders. You can look for turtle soups. You can look for momentum bars on the 15-minute chart, breakouts. By the way, this black line here is the weekly pivot. So once we break above that and the 200 SMA here, the blue line, you could get in. Important is really that your thesis from the higher time frame is in place, and not just one time frame, but multiple time frames. And then you can time your trade on the lower time frame. Now there was a very similar trade here on the 1 hour chart just a couple days later, where again we can draw a trend line in the direction of the trend. We pull back into the 50 EMA on the 1 hour chart. We fake out yesterday's low here, and we also have the weekly open. So once we break above that, we can get in. We can also get in at the pullback. We can also get in after the reaction to the pullback. There are tons of ways to get into a trade once you have your thesis in place, and that will be the easier part. A lot of people, they put way too much emphasis on the entry itself, whereas my work is pretty much already done before I ever click buy or sell, because I have my thesis in place from the higher time frames, and I'm only waiting for an execution pattern on the lower time frame, and that could be anything, literally anything. And then of course it also comes to trade management, where you put your stop loss, your take profit, how do you trail your profits, how do you manage your losses, do you take partial positions, etc. That's a whole different story. But again, here multiple time frame analysis can be incredibly helpful, because this trade that I took down here, even though I executed it on the 15-minute and the 5-minute chart, and I framed it on the weekly, daily, 4-hour chart, I managed it on the 1-hour chart. So if you're getting in down here with your stop below, and then what I typically do with these trades is to trail them behind the 1 hour 50. So we're still sitting in this right now at 5.8R. And then you could of course say, oh, okay, I'm more aggressive with my entry, boost this to a much bigger R number. Here is the weekly open, here's the monthly open. Around here you could move your stop to break even, manage it, and then you move up to the 1 hour chart and you trail the 1 hour 50. You wait for a close below the 1 hour 50 and, for example, a swing point. So here we already have the close below the swing point, but we haven't broken the 1 hour 50 EMA yet. So we could wait for another reaction here. And then of course you can add other tools to this. For example, Fibonacci extensions, Fibonacci retracements, Elliott wave theory to determine your targets, etc. But I hope it's clear that you need rules for each of the time frames that you use. You don't want to switch around the time frames all the time. So I'm not going from the daily here to the 6 hour or the 8 hour to see if I see something else there. You want consistency in your trading. That's most important. You want to have rules in your trading. You want to follow those rules. You want to know exactly what you are looking for on each of these time frames. What is your analysis time frame? What is your execution time frame? And then if you are really executing the trades on a lower time frame in the direction of the higher time frame trend, or with confluence of higher time frame levels, then your win rate is really going to increase by quite a bit. And you're also going to increase your yield, because now you're not just trading, oh, okay, there is, for example, a triple tap here, momentum triple tap in the direction, and I'm reversing from yesterday's low. No, you're knowing that you're actually going with the overall time frame, with the overall trend on the higher time frame. So you can hold this trade longer with more conviction. You're going to make fewer errors doing your trade management, because conviction and confidence is, well, it's a huge part of success in trading, and it can only help. So while it might be confusing in the beginning, and of course you don't have to look at 6 charts at the same time, you can just look at one chart, one by one by one by one, and then go lower, lower, lower. I like to see all of them at once, because that's my style, that's how it makes the most sense for me. But trading is very personal. Whatever clicks for you is the best. And of course you can always just go full screen as well and then zoom out like this, yeah, and try to gauge the momentum like this. But to be honest, I don't really like that, because one other thing that I really like is to always have the same amount of bars on my charts. And for example, on these smaller charts here where I'm zoomed out a bit more. I like to have around 150 bars. So I have consistency in my pattern recognition. That's super important. And then up here, for example, on these charts, you can look for when these bars switch from thin to thick. That's exactly the zoom level that I want to have. Like this. And then I always have the same amount of bars on my charts. And then I don't need to like go full screen here and zoom in and zoom out. And then because the scale will also get crunched, right? If you have a not trendy time like this, then your charts are gonna look like this. And you know, this is an 80 pip range. And then if you have a trendy time, your charts are gonna look completely different. Now this is a 160 pip range. And that's a totally different look and feel to the chart. And another thing that you have to think about is the scale here on the right, auto scaling. Yeah, sometimes if you are really scaled in like this, then this looks like a huge move because it fills your whole screen. But in reality, it's just a small move in the overall trend. And that might influence your decision making as well when you are trading in real time. So I like to have my charts always on the same zoom level. And I also like to be very aware of what the scale is here on the right side. So I just look in the morning, okay, what are we looking at here? It's a 60 pip range, okay. And then here's a 30, 40 pips range. Here's a 180 pip range. And then over time, you will develop a feeling. It's like, okay, this is actually quite a big range for GBP Swiss. You could also use an ATR or an ADR or whatever works best for you. You just want to always be aware whether the instrument you are looking at right now is moving nicely or whether it's just messing around and you're just paying a lot of spread to get in and out of trades that will go nowhere. Anyway, I'm ranting on too much here. This is multi-time frame analysis. Always have rules for every single time frame that you use. If you don't have rules for a time frame, then don't use the time frame. You want to know exactly what you're looking for in each of the time frames, and you always want to be looking at exactly the same time frames, and you want to be aware of the volatility on each time frame, what is normal for that pair, what is normal for the instrument that you are looking at, and what is abnormal. And then you can make informed trading decisions based on multi-time frame analysis, trading with the higher time frame trends and levels, and executing on the lower time frames for increased win rate, increased risk reward, and a lot more fun in trading.